Are you looking to develop or expand your property portfolio? Well, I'm going to talk to you about our momentum investing formula. Before I do, let me just introduce myself. My name is Harvey Bowes. I'm the Managing Director of Harvey Bowes, expert mortgage and finance brokers, multi-award winners, and we deal and specialise in dealing with property investors. And what I'm going to talk to you now about is our momentum investing formula. Now, there's a series of these short videos on our website. This particular one is going to deal with momentum investing with single let properties, but you can also refer to our momentum investing for HMOs and for serviced accommodation. There are some similarities in the strategies of all three, but there are also some key differences, and that's why we've separated them out into three individual short videos. So, momentum investing for single let properties. Well, what's this all about? Well, if you're looking to build a property portfolio, I'm sure you'll agree with me that property is a very expensive game. And so what you'll find is that if you have cash sums, even if you have quite significant sums to be able to invest in property, the fact is, because it's an expensive game, those funds will soon run out. And that's why a momentum strategy is very important, because it'll allow you to recycle your cash so that you can keep on investing and keep on growing that portfolio. Perhaps you're looking to grow your portfolio because you want to build a pension for the future. Perhaps it's a legacy for your children and their children. Or perhaps you just want cash flow right now, and so you're looking to remove yourself from your corporate job or your normal business, and you think that by building a property portfolio, you'll be able to do that. Well, we have many clients that have successfully achieved all three of those goals, whether it be all three in total or whether it be all three individually, depending on what their circumstances and their aspirations are. But the momentum investing formula is a brilliant way of achieving exactly that. So what do we do? Well, first of all, the most important thing is the aspect of below market value, BMV. The strategy that I'm going to talk to you about today is about creating gain. It's not about buying below market value. If you buy below market value, which is all well and good, but the reality is lenders are concerned about those type of transactions. So what we're focusing on here is buying in a way where you add value to a property, and adding value is key. Now, in terms of single lets, let's say for example you buy an older property, a property that needs refurbishing. Then that refurbishment is one gain. Let's say that you could reconfigure the property and add an extra bedroom. Perhaps you take a typical Victorian terrace house from a 3-bedroom to a 4-bedroom, or from a 2-bedroom to a 3-bedroom. Whatever the case, that's also adding value, creating gain. And normally, to make this strategy work, the gain has to be significant if it's one single gain, or alternatively, if you find more than one gain in a property deal, then you should be able to refinance and recycle the cash that you've used so that you can move on to the next project. And don't be concerned about the 6-month rule either, which is something I'll come back to. So I like to segregate my gains. In other words, if I see a property that I'm interested in investing in, then I will think, can I do a refurb? Can I reconfigure it to add a bedroom? Two typical ways of doing things, but I separate those two gains for that property. And I know that if I can get 2 gains or more in a property, then it will be absolutely fantastic deal, potentially, as long as you buy it for the right price, of course. And you'll be able to then refinance and move on. So the first thing I look for is whether I can get more than one gain by sort of segregating those gains. Perhaps another gain would be the fact that the property is currently leasehold, but for a very low amount of money, in many cases, in many parts of the country, you're able to buy the freeholds for typical Victorian terrace houses, for example. Perhaps another gain would be adding an ensuite. Not as good, obviously, as adding a bedroom, but it's still another way of adding gain. The key is also to do your refurb to a high standard, so that when the lender's valuer comes in, when you refinance that property, they can see that there's some care and expertise that's gone into the refurbishment. Now, I said I was going to come back to the 6-month rule. As many property investors are aware, there are a large amount of what we call vanilla lenders, the typical lenders in the marketplace for buy-to-let, who will not allow you to refinance a property within 6 months. However, there are some very competitive lenders in the marketplace that understand what property investment is all about, and they will allow you to refinance your property inside of 6 months, provided you have added value. So if you've just bought it, you want to refinance it, that's not going to work. If you bought it from an auction and you've done some refurbishment work, and perhaps that refurbishment work has only taken 2 months, and you now want to refinance that property, then you can do that. You can do it on the open market value as well, not just your purchase price. Now, if you've bought from an auction and perhaps you've paid cash for a property and you want to refinance it quickly to bring your cash back to you, then that can be done with any number of lenders. Large number of lenders will allow you to do that as long as you're borrowing against the purchase price that you paid. But here you see, if you add value, even if that refurb's only taken a couple of months and is relatively light, as long as the work that's done is good quality, you can refinance on the open market value. And that's what will really help you to momentum invest. In a moment, I'm going to go through some figures to illustrate that for you. Before I go through the figures though, I want to go through how you handle the valuation for these properties. Because I'm sure you agree with me that in reality, when a valuer comes to see a property, the RICS surveyor, they're professionals in what they do, and I respect them, but they can sometimes be guilty of looking at what you've paid for it. Perhaps they've got that information from Home Track or from Land Reg. They'll look at what you've paid for it, they'll add a little bit to that maybe because they think you've done a 10 or a 15 grand or a 25 grand refurb, and they'll just write that down as the price of the property. Well, how do we avoid that happening? Well, first of all, I would always recommend that you keep a good record, even if it's a brief refurbishment. Always take pictures before, as the property was, as well as taking pictures afterwards, as the property is now. Now, you may be thinking to yourself, why would I take pictures afterwards? Because the valuer that comes in for the refinance or remortgage of the property is seeing it in its current state. They're seeing it fully refurbed. But here's the reality of the situation. How many valuations do you think that valuer will do in a day? If it's commercial with HMOs, perhaps it's only 3 or 5. But if it's a combination of residential and buy-to-let, it could be as many as 10 to 15 valuations in a day. Do you want your property to stand out above the rest? Of course you do. Do you want the valuer to remember that you've done a good quality refurbishment? Of course you do. And that's why I would always recommend that you have plenty of after pictures put in your property in the best possible light. It also shows that you are a property professional. If the property is also let out, I would still recommend that you arrange with your tenant that you will do the valuation. I think it's important, particularly on revaluation, not when you're purchasing, but when you're refinancing. I think it's important for you as the investor to meet with the valuer for that property. When you meet with them, show them your strength of covenant. Now, what do I mean by strength of covenant? Well, we've already dealt with showing them the pictures, but now we're talking about strength of covenant. And I'm going to illustrate that to you. So imagine now, to move away from a standard family let, but just for illustration purposes, imagine that you've got a shop front, and you own the shop and you want to rent the shop out. Which tenant would be safer and have greater value for you? A major chain like Costa Coffee, or a local one-man band serving sandwiches? Well, both of them may well be paying their rent on a lease. That's absolutely fine. I don't want to besmirch anyone. But the reality is that Costa Coffee would be seen as a much better bet as your tenant. It would add value. And that really illustrates strength of covenant. So if you're going to illustrate strength of covenant to a valuer, really what you need to tell them is, what type of tenant have you got? Is this a professional? If not, perhaps you've got LHA or DSS as it used to be called, local housing allowance. That's absolutely fine with a number of lenders, not all. But the reality is this: how are you getting paid? Are you using an escrow account, or have you got the rent assigned to you directly, so you're being paid by the council perhaps? If you have, then that adds to your strength of covenant. It shows that you've thought of and planned a way to be collecting the rent from that tenant. That will make the valuer feel more rest assured, because it's not just about valuing that individual bricks and mortar. It's about the whole package when it comes to property investment. So a full schedule of works as well. So point 3 is to have a full schedule of works so the valuer can see exactly what work you've done. On a normal single let property, If you're going to the lenders that are fairly vanilla but allow you to refinance in 6 months, then I would always prefer to be presented with a non-costed schedule of works. But if you're going with some of the leading lenders in this market space that really look after property investors, then they're lenders like Shawbrook or Cambridge and Counties Bank. Those sort of lenders will be looking to see a costed schedule of works to understand exactly how much you've paid for that property. The fourth aspect is again dealing with the valuer, and that is getting all of your certificates together. So preferably the original and a copy, so the valuer can take a copy away if they want to. What do I mean by your certificates? Well, if you've replaced the windows, you should have fencer certificates, your gas and your electrical reports and certificates, and if you've got an EPC, hopefully you've got one ready because you've got a tenant just about to move in, or you're marketing it to tenants, or hopefully a tenant has moved in. Whatever the case, you should have an EPC. So once you've got all of that information together, I'd also present that to the valuer if they want that information. So it shows them that you are organised, you are professional, and you're doing things in the right way. It may also be useful, as point 5, to have some of your own comparable information. Now, it's quite difficult to get comparable sometimes, but any comparable that you do have should be also preferably a freshly refurbed or good condition property, but more importantly, one that has sold on the open market within the last 3 months, preferably in a buoyant market within the last 6 to 8 weeks, but 3 months is usually acceptable. If you can get 2 or 3 comparables, that helps to substantiate the value that you're now putting on your property, the open market value, which is the value you want to borrow against. Now, as I said, a little bit later in this short video, I'm going to go through some figures with you to give you an idea of what can be accomplished in a typical environment. Another aspect that's really important is to get your paperwork together for the lender. Now, this simple paperwork so many people forget, but it's important if you're investing in property to have a separate bank account for the collection of the rent and the other then expenses, particularly mortgage payments, that are also needed. Now, we have some clients that choose to have a separate account for each and every property. I'm not sure that that's quite necessary, but that's certainly a way to manage the situation. But if you have a property dedicated account, so it's very easy to see the rental income coming in and also seeing the mortgage payments and other expenses going out, then that's very easy for lenders to pick up on. And a number of lenders, to be comfortable with you, will want to see 3 months, if not 6 months, of those bank statements. We're now in an age where lenders are being so much more careful about the way that they lend. It doesn't mean they're not lending. In fact, the market is remarkably buoyant at the moment. But as this video is going out to you, or being published, there are statistics that show that the default rate in the UK is the lowest it has been in history. Now, that's an incredible claim to be making when the credit crunch was just only a few years ago. Yet that's where we are in the marketplace. Lenders are making good lending decisions. If you want to be one of those good lending decisions, then organise your paperwork. So, as I say, 3 months, if not 6 months, would be preferable of bank statements on the ready. Lenders will often accept online bank statements that have been printed directly from your browser, as long as they have the HTTPS signature at the bottom of the page. That shows you printed straight from browser and that it's been on a secure email. They will then take that as original. Of course, you need to provide your broker with those original hard copies. What you also need to provide is your proof of income. So if you're self-employed, your SA302 or the equivalent documents, at least 2 years, if not 3 years, should be available. Some lenders will accept your accounts if your accounts are from a recognised firm, but quite often we see property investors submit forms to us for accounts that aren't signed, either by you as the self-employed person stroke director, but also not by the accountant either. They need to be signed by both of you to be acceptable. And then you need your proof of ID, passport, a utility bill, preferably dated in the last 2 months, and that must be a proper utility bill as opposed to a credit card statement or something along those lines. If you're employed, then proof of income would normally be seeing 3 months worth of pay slips and then the corresponding bank statement that shows that income going into the bank. If you get that organised, ready to present to your broker, the lender may not need it all, but the point is, if they do come back and ask questions, you can respond to your broker very quickly, your broker responds to the lender very quickly, and you get a much better experience in your mortgage applications. If you're looking to momentum invest, then it's really key to have the valuer and the lender on side. Now, I've only given you a few snippets of the information that we give out on this to our clients. So if you want to know more about this, please get in touch with one of the team at Harvey Bowes. In the meantime, let me show you some figures. So let me illustrate some figures for you. Perhaps you invest in South Wales, perhaps you invest up north, which would be similar figures to where I invest, which is South Wales. I'm going to use those figures, but obviously wherever you are in the country or wherever you're looking to invest, you'll have your own figures. You need to do your own due diligence. If you call into Harvey Bowes, of course, we can discuss the figures with you on a one-to-one basis and tailor them towards what you're looking to do. But let's have an illustration. So let's say, for example, you buy a property and you pay £75,000 for that property in need of some sort of refurbishment. Now I'm going to use specific figures that work for me. I bought a terrace house in Maindy, an area of Newport in South Wales. I paid £75,000 for it. It was a probate sale. I added value by doing a light refurbishment. It had a great kitchen, horrible bathroom, so there were little bits that didn't need doing. But in that, I reconfigured the upstairs to go from a 3-bedroom to a 4-bedroom. And by doing that, obviously I added value in that way as well, as I referred to previously in the video. So £75,000 is your purchase price, and that would mean that you put down £18,750 deposit if you took a 75% loan to value. Other ratios of loan to value are available for buy-to-let mortgages, but in this instance you take it on a short-term loan. And the reason for a short-term loan is to be able to refinance it. So the mortgage you took then would be £56,250. And as I say, the deposit that you've placed down, plus your purchase expenses, of course, is £18,750. Now, when I added value to this property, I then got a valuation on the self-same property for £110,000. So what happened to my figures then? So once I'd refurbished the property and I'd added value, I got a valuation inside of 6 months at £110,000. And from that, I chose to take an 80% loan-to-value mortgage, because they are available on buy-to-let at the time this video's gone out. That therefore gave me a mortgage amount of £88,000. Plus, of course, there are some fees. But for illustrative purposes, the fee on my particular deal I went for on this was £995. So that fee was added to the loan. So the loan became slightly more than the 88, obviously 89,000. Now, the £18,750 I paid for the property, I had a £56,000 mortgage. I spent £8,000 on the refurbishment. So you can see exactly how those figures work. Because if you take the £56,250 I owed the previous mortgage lender, I've now got £31,750. Equity release. So that's the difference between the first short-term loan I took on the property and then the new long-term mortgage that I took on that property, interest only, over 20 years in this instance. So with £31,750, clearly I've been able to recycle that property in a short space of time. I've got all of my refurb money, all of my £18,750 deposit back, plus all of my expenses, my valuation fees, my legal fees, and my fees to remortgage. That's a great deal. It's entirely possible if you add value to property. So I'm not talking about just buying below market value and trying to get a lender to refinance it. That will not work in this way. What I'm talking about here is adding value, genuinely adding value to these properties, getting a good quality tenant in, and then being able to refinance the property so that I can reinvest my money in the next property. I hope you found this short video useful. Please get in touch with one of the team at Harvey Bowes. Our number is coming up on the screen now, and I'll look forward to talking to you.